Yeah, if there's information about the expectations of the market embedded in market prices, that means that you can't outperform the market by just guessing where that price is going to go on a consistent basis. Frankly, you'd have to know something the rest of the market didn't know. And to your point, I mean, how much trade volume was there on a daily basis in stock markets last year?
It's over $1 trillion.
Yeah. So you're swimming upstream. You're basically saying, I know something the rest of them have not been able to find.
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Are markets broken? And if they are, how do you know? That is the topic today on The Informed Investor. We are going to talk about the efficiency of markets. The show is brought to you by Dimensional Fund Advisors, an asset manager bringing financial science to investing. And if you're enjoying the show, be sure to hit the subscribe button. I'm Mark Gochner, joined today by Jake DeKinder and Wes Krill. And guys, we talk about markets. I'm going to set up an example here, and then I want you to give some comments to it. Go in a grocery store. I think many consumers go in a grocery store and say, I'm going to give me some milk. And they go, let's say it's $4 a gallon. How many people go, nah, I don't know about that. I think it should be priced $4.05 or maybe $3.90. Yet somehow when it comes to looking at the prices of stocks, there's this belief out there that, oh, that's not right. XYZ stock's trading at $10. Totally wrong.
What is a market? It's simply buyers and sellers come together, transact at a price where they both feel like they're getting a good deal. It's based on supply and demand, and it's based on the information that we have at that point in time. And to your point, Mark, whether it's a grocery store, filling your car up with gas, any of the things that we purchase, we sort of accept this idea of market prices, and we're very comfortable with it. We map that over to the stock market, and there's a large portion of investors in the world that think somehow it doesn't hold up when you have massive trading volumes and literally millions of people coming together every single day. It's a weird concept.
Yeah. So let me read a couple headlines here, and then we'll define market efficiency and what we're referencing. Because I do think a lot of people, they hear the term market efficiency, and it probably means a lot of different things to different people. All right, first headline here. If prices are wrong, you should be rich. I love that one. And the other one here, market efficiency is impossible. Here's why and why it matters. All right, so let's start with just the idea of market efficiency. Wes, I'll go to you. Like, how do you think about defining that in the context of where we're going to go today?
Funny thing is, I actually agree with that second headline, but we'll get there eventually. For the first headline, they should have said, if prices are wrong, I don't want to be right. But again, we're going to get to that.
We got in late last night from San Francisco.
I know.
Like, what do you mean?
I need more coffee.
I'm trying to mess with you guys already in the beginning of this. The definitional aspect of this is really critical because people probably have their own perception of what it means for something to be efficient. Like my toaster oven is efficient because it works pretty consistently, doesn't give me a lot of grief, doesn't introduce a lot of volatility into my life. That's not what we mean when we say markets are efficient. It's not an operational thing. It's an informational thing where it means market prices reflect information. Now, the levels, the types of information, I think that's where people might have their own definitions around that. But frankly, it just means anything that is relevant for the cash flows of businesses. If it's known to market participants, it's going to be reflected in market prices. And that sets up a lot of things that would be predictions based on those circumstances. But I think getting people to understand that we're not saying you can't have market volatility. We're not saying there aren't going to be some managers that can outperform over long stretches of time. What we're really getting at here is it's just the informational aspect. And to your point, that's really the latent function of a market. Mm-hmm. Yes, it's a tool for allocating resources within a marketplace, but it also provides information based on the activity of people who are trading in that market.
Well, we also talked about this idea of this word right, or the right price got brought up. And I don't think that's not what we're saying. Like, nobody knows what the right price for a stock should be, right? It's a fair price based on the information that we have. It's a fair price based on maybe the risk that's associated with that company. And that's what investors are doing. They're coming into the market and they're expressing that view of, I don't know what the price should be, but based on everything I know, there's going to be buyers that line up on one side and sellers that line up, and they're like, yep, that seems like a fair price as of right now.
Yeah, I think a lot of people, they hear the term market efficiency and they think, well, that's what saying stocks are perfectly priced.
No.
We're saying they're not. But what we are saying is that the flow of information is in there and usually in prices very, very quickly.
Yeah, if there's information about the expectations of the market embedded in market prices, that means that you can't outperform the market by just guessing where that price is going to go on a consistent basis. Frankly, you'd have to know something the rest of the market didn't know. And to your point, I mean, how much trade volume was there on a daily basis in stock markets last year?
It's over $1 trillion.
Yeah. So you're swimming upstream. You're basically saying, I know something the rest of them have not been able to find. Now, that might be true. We can get into some of the sort of edge cases around why markets probably aren't perfectly efficient, why they almost can't be for them to be well functioning. But that doesn't mean there's just opportunities everywhere.
Well, also think about the opportunities, right? We're talking about at this point in time, here's the issue. You can't predict the future, right? And even if I gave you a perfect model for the future, I can't give you a perfect model for how the market's going to behave based on those events. And I think that's the challenge, right? It's not that we can't analyze the information. It's not that we can't come up with a good expectation for stock prices. It's that to say somehow that it's wrong and therefore in the future, here's what it's going to be. I can't predict it, and I can't predict how markets will react.
Yeah, market prices very rarely hinge on just one item. This made me think of that story recently about Polymarket, where that guy had bet on a temperature spike in the center of Paris, and then he takes a hairdryer to the thermometer as being used to evaluate that temperature change for the purposes of his bet. Gets it right, cashes in, but that's because
did they pay him out?
As far as I know. But I think that's really an important contrast here, because that's something that hinged on just one thing coming true. To Jake's point, I mean, there's lots of things that are influence stock prices because they're a function of hundreds of moving parts.
Well, also on that too, I mean, you're thinking about temperature, right? There's only so many ranges of outcome of what the temperature can be in a city, right? We're relatively limited, and it's a relatively normal distribution. I mean, you can argue it's changing over time, but that's a separate conversation. You know, with the stock market, what we know is stock market returns aren't normally distributed, right? So now you're taking something that has even greater variability and trying to say that I know what it's going to be.
You can't prove markets are efficient. You can't prove they're not efficient. But there is some evidence you can start with to say, if we think about market efficiency, if prices are so wrong, kind of is that first headline, right? If prices are wrong, you should be totally rich. You just don't see a lot of folks systematically creating unusual levels of returns, right? So that's some evidence there. The market seemed to be functioning pretty well when we're talking about this flow of information.
Yeah, I mean, you make a good point about why there's even objections to this in the first place, because it's a very sound, sensible framework. But, you know, it's a model, which means that to test it, we got to have some sort of set of data that you can use to say, okay, here's a prediction based on this model, and here's how I'm going to test it. The problem in the case of market efficiency is you're testing two things simultaneously. You're testing whether this model is correct, that prices only change in response to new information, but then you also have to have a model for how much they should be changing in response to new information. And so it's what we geeks in the industry call a joint hypothesis problem, where you got two things, and so you can't isolate it to one of those models. But that's besides the point. Just because we can't prove it directly like that, we have lots of indicators where it would suggest if this actually holds within the marketplace, what would we expect to see or not expect to see. And certainly rampant manager outperformance on an active basis is something we would not expect to see, and we don't.
I mean, go back to the first studies in the 60s when we finally got a hold of data, and Jensen run some of the first studies on manager performance, right? And I think people were really surprised by that, because up to that point, I think there was a view of professional money managers have more information, have more skill, work harder, do all of these things. Of course, they're going to do better. And you start looking at the data, and it's like, no, they don't. And now we're, 60 years past that, and what you see consistently is when these studies are run of, it's really hard to outguess the market. And to your point, like, we may not be able to prove it on the efficient market hypothesis side for all the reasons that you said. We got a whole lot of data on managers trying to do it.
Yeah. Well, a couple of questions that we get at various events that we run, I'll ask you guys to get your thoughts on them. One is, hey, over time, have we seen markets become more efficient or perhaps less efficient?
Yeah, you could probably argue that in two different ways, frankly. I mean, you could say, okay, given the increase in liquidity in markets, the speed with which people can trade, that's probably vastly greater than it was 30 or 40 years ago, you might expect that would increase the efficiency of markets. And when I say that, I mean increase the speed with which information is procured or retrieved and then incorporated into market prices through trading activity. So that'd be on the pro side. On the con side, you might say, well, maybe there's fewer market participants who are trading actively, so to speak. So you've had a rise in indexing over the past 20 years, where I think it's even more than 50% of fund AUM is indexed now. And so you might say, well, that represents fewer investors going after it. So again, all of this stuff is really hard to argue exactly, because at the end of the day, we're talking about a model. All models are going to come up short when they're actually tested very rigorously. That's the point of a model. It's an abstraction, an oversimplification. The point for investors is how it falls short and what are the implications there for the way you invest.
Well, I was just going to mention even Eugene Fama, who was at a conference we were hosting not too long ago, got that question. Of course, Gene coined that phrase, market efficiency, right back in the 60s.
Well, it's an interesting point, too, on the indexing side, right? You have had sort of this growth of indexing, this growth of index funds, and I think it's a valid argument you put forth. But at the same time, we know that some of the most traded securities out there are ETFs that are indexing, right? And also, and I think you've run these studies, that even if you look within the S&P 500, which is probably the most indexed part of the market anywhere, you still see massive dispersion in returns of the individual constituents of the S&P 500. So to me, that tells you that it's not all moving together, right? There's still plenty of price discovery that's going on. There's still plenty of trading that's taking place out there. And look, when you have a lot of trading, you have a lot of volume, you have a lot of liquidity, you have a lot of buyers and sellers, that's when it moves towards an efficient market.
It's a good point where we can't settle this definitively, and so you're just looking for where's the smoking gun if there's any erosion in terms of market efficiency. The trade volume stat is a great point about the index ETFs. 3 of the top 10 highest trade volumes in U.S. listed securities are index ETFs. You have other avenues for price discovery. When we talk about the percent of the market that's in index funds, we're talking about mutual funds and ETFs. We have all of these other channels for getting information and prices. You got futures markets, you have forward contracts, you got IPOs, SEOs. There's lots of ways that people can express a viewpoint on the market, and that comes back to this idea of getting information into market prices. They're expressing their viewpoints that incorporates it into market prices going forward.
I'm going to read another headline here and then ask a question from this one. Investors feel pain from inefficient, crazy markets. So this idea, hey, there's just so much volatility, these huge price swings, everything seems a little bit wobbly in the markets. I'll connect that to the other question we get is, well, what about bubbles? Mm-hmm. If markets are so efficient, how can there be a bubble like the tech bust there in the late, I guess it was 2000, kind of right in there where that really started, or the financial crisis in 08, 09? How could that happen if markets are so efficient to where you have a 50% drop in markets?
We can start with the volatility aspect. People should not conflate that with a lack of informational efficiency. If anything, they should think of that as the very way it is occurring. When you have rapidly changing information, which you often have in a market downturn, then you should expect market prices to be going up and down very rapidly to reflect whatever the latest information set is. In fact, if they weren't moving in a very volatile way, that might be a sign that you no longer had a well-functioning market. And then the bubble thing, it implies that you know at any given time what the correct price is. And that's really one of the definitional terms of efficiency. It doesn't mean prices are right. It means it's the market's best guess in aggregate, but they can be wrong, and they might be in the future. The key is that's useless information to me unless I know when that bubble, so-called, is going to pop and how I can profit from it.
Well, I think 2 points there. One, bubbles are really easy to identify after the fact, and they love to write a lot of articles about it. But I think this gets at Wes's second point, which is to do anything about it, you have to be able to identify when you're in it, when you're going to get out of the market. If you do get out, when you're going to get back into the market. And so to me, that's the bigger question, which is, so what are you going to do about it as an investor? And all of this idea around market efficiency, that's what it gets at. It's almost like a mindset of how are you going to approach investing, and less about, is it perfectly efficient? Are prices right? Are we in a bubble? Are we not in a bubble? I think those are some of the wrong questions. It's what do I do about it to have a good investment experience?
So what should an investor do then? Based on, if I can't prove either way, so what do I do?
Okay, look, in my mind, you sort of have 3 broad states of the world, or 3 broad ways to think about investing. One is, I think markets are broken or can be outgassed. That's what you led off with, right? And that's sort of what the industry was built on. That's traditional active management, stock picking. I can do better than the market. You have a second category, which in my opinion is indexing, which is it's grown, but I don't really do much with market prices on every single day, a basis every single day. And to me, that's a weird way to approach it. I'm just going to completely ignore market prices. Or you say there's a ton of information in market prices. It tells me something about what I should expect to earn on that investment. And actually, I can use that to my benefit over time and not fight it. And you kind of, as an investor, sort of have to say, which camp do you fall into and what do you want to do about it?
Yeah, that's really the only relevant aspect of all this. The reason why we talk about these kind of conversations, the reason why we entertain questions around market efficiency or, does it hold or does it not, is all of this sets up the way you view your investments, whether you want to try and outguess markets, whether you want to accept the market prices. I think it also reframes your perception of price movements. So we talk about this sometimes in the case of bonds, where if you have a bond that is rated as a triple B, so it's investment grade, but its price is much lower than most other triple B bonds. It has yields that are high enough where it starts to look like a lower tier of credit quality. So if you did not believe in any of this market efficiency mumbo jumbo, you would look at that as a buying opportunity. You'd say, this bond is underpriced. I'm going to get an abnormal return than I would have gotten otherwise. If you believe in market efficiency, you would say that the price is probably telling you the information you need to know about that bond, and it probably, if it looks like a duck and quacks like a duck, it probably is a higher risk security or lower tier of credit quality. So that's what I always think about, is it just reframes the way I view occurrences in markets.
I think it also frees you up. If you sort of adopt this view of market efficiency, prices, accept prices, do all of those. I mean, it's almost liberating as an investor, because when you do get these periods of high volatility and you do get these big drops in the stock market because of new information coming in, rather than getting concerned, you almost flip your thinking and you're like, actually, markets are doing exactly what they should be doing. Trading volumes are high, new information is getting incorporated. Yes, volatility can spike. Yes, the price of the market or an individual stock can go down, but it almost flips your thinking of nothing's broken, things are working the way that they should, and the market's just repricing the current information.
Related to that, I think a lot of investors say, yeah, but I think this is going to happen in the future. And I take that idea of, that's a pretty bold statement to say somehow me, just reading a couple of headlines or reading some stuff in a newspaper, can somehow outpredict everybody else out there doing the exact same thing, some of whom are complete professionals and looking at this stuff all day long. And there's still no evidence that they can do that consistently, which I think goes back to what you guys were talking about, which is, but the future is uncertain. It's absolutely uncertain. But with that said, and I think this is part of that liberating aspect you're going at, is the forward-looking nature of markets. Like, they still are putting some sort of, they're anticipating what might be happening to these cash flows into these companies. I think for me, that's incredibly liberating too, because I don't have to worry about somehow, well, they're not thinking about this or thinking about that could happen. It's built in there in some way.
Yeah, you got to know something. That it's one thing to say I have a prediction about the future. You have to have a better prediction than the rest of the market, or know something the rest of the market doesn't know. By the way, this is why insider trades are profitable, is we know there are some people who have information the rest of the market doesn't have. Company insiders. This is why they're not allowed to trade in between quarter end and when they disseminate the information around their earnings, because they do know something that's going to move prices. Of course, you don't want to do that because you're going to go to jail for a very long time.
That is a risk-return story.
Right? It is. It is.
But also, I mean, it kind of gets at the question, so, like, why are we still having this conversation however many decades later that we've had the evidence? And in my mind, there's two big reasons. The first is, in most aspects of life, and we're sort of taught this, work harder, be smarter, keep pushing, and you're probably going to do better in life, right? In investing, it's almost the opposite. That it's almost like the harder you try, a lot of times you almost have a worse outcome. Your trading costs go up. You might miss market opportunities. You're sitting in cash. You got a tax aspect to it. So I think that's one part of it. And it's tough for people to get over that mental hurdle. I think the second thing, too, is that I think that there's a portion of the population that just is greedy and likes money. And I don't mean that in a bad way, right? Like, we want to provide for our families. We want to do these things. And I think when there's this opportunity related to money of, man, if I could do it and if I could get it right, think about what that could mean for my wealth, for my money. And I think you put those two things together, which is why I don't think this conversation's going away.
Yeah, I mean, it's like that perfect market timing experiment you guys always run. That if you could get all these calls consistently right, you have all the planet's money after 10 years. Yeah, I think it's the anti-American spirit, as we sometimes joke. That used to be one of the terms that was coined around this idea of indexing, is like, oh, that's just kind of giving up. But I think it's a really important point about now we can get into some of the limitations around market efficiency, which are totally fair. In fact, there was a phenomenal paper back in the day where there were some authors, Grossman and Stieglitz, who pointed out that there is inherently a paradox where if markets are perfectly efficient, then everyone's going to act that way, is not going to bother looking for information that's not in prices. Well, then you don't have the price discovery process of information retrieval occurring, and then prices would start to drift away from efficiency. So the takeaway from that paper is you have to have just enough efficiency effectively to induce active managers to look for things, and it sets up sort of a new equilibrium where their abnormal profits would be basically offset by the cost for retrieving that information. So the point is, again, not so much that is market efficiency 100% the case, it's whether it is or not, how should I act as an investor? I think that's my ultimate takeaway, is most investors are best served by behaving as if markets are perfectly efficient.
I think that's really well said.
Well, and a third one I'll say to you, why people tend to invest the way we've seen historically, is that's all they know, right? That's all they hear on the media. That's all they're reading about. That's all they've been taught about investing, is that's the stuff you do. So there's point of this show, the Informed Investor. Around that. The last thing you said there too, Wes, I want to play off of, which is think about, again, how we live our day-to-day lives. We talked about going to the grocery store and you just pay $4 for milk because that's probably what it costs. We think about we're going to go downtown for dinner, right? We pull out Waze or Google Maps and we think, okay, that's what's telling me the most efficient way to get to that destination. That's market efficiency in a way. That's just taking current information and assembling it into helping you make decisions that we do. And Jake, we were just in California. We were having an event and David Booth, our founder, was there, and he was talking about this idea of public markets. And this whole conversation is about public markets, right? And but he was talking about how we should be celebrating, rejoicing in the fact of where we are in public markets, how efficient they are in terms of the flow of information, and how cost effective it's become to be an investor.
Think the trading volumes we talked about, the investor protections are in place, the cost of it's come down, the diversification's up. You can do it globally as well. I mean, what an amazing time to be an investor. And I love when David says that, celebrate the beauty of public markets. And I think that's a great mindset to go forward with.
This is probably besides the point, but I love the Waze example where you're using dynamic information sets to update, what the appropriate route is to get through a city. That's a great argument for not indexing if you believe in market prices. We'll save that one for another day.
I would agree. You ever tried to fight it too? Like you're like, I'm going to do a different route. That never works out well.
So doing a different route, that's an acting manager, right? I know more than
that's right.
current information.
I don't think there's actually a road blockage. I don't believe him. I'm going this way.
Right. And the indexers, they don't look because
take the
they
same route every day.
once a year. So I'll just use the map I used 6, 9, 12 months ago, whenever they last reconstituted.
Yep.
One other thing on an investor I wonder out there is if there's this expectation that if I go out there, I buy a stock, somehow I'm getting taken advantage of, right? Well, like, let's say you go buy a house, it's $1 million home, and then once you get in there, you're like, okay, they didn't disclose termites or a roof, or like, I'm getting hosed on this deal. The house is really only worth $800,000. And I don't know if investors take that into, I buy a stock worth $40, and it's really only worth 30. I think they can have confidence it's probably somewhere around $40. They're not getting taken advantage of in going out there and transacting in public securities.
Well, no, go ahead.
Well, I was going to say there's competition to drive that price to an equilibrium where half the people think it's too high, half the people think it's too low, like we often talk about. In the case of whether they're going to get their eyes gouged out, there's also a huge amount of investor protections I think you guys highlighted in one of the previous episodes. And so there are rules set up that can lead to prosecution if people violate these to keep investors from getting sold a false bill of goods.
I love your house example, right? Because let's say that for that particular house, you got 500,000 buyers and sellers that got to come through, right? Do you think the termites then would get priced into it? Probably, right? And so that, again, you don't have to have like a crazy volume to believe in market efficiency and the concept that we're talking about. But in your house example, right? I mean, think about that just logically. Like if you could have millions of buyers and sellers coming together to come up with that price of the house, you'd probably be like, yeah, there's a lot of information that's baked into that thing.
Also, which area has a higher price per square foot for homes? Southern California or the middle of Montana?
Well, I don't know. Montana's going up quite a bit.
If it's a
All I
resort,
got to say is markets work.
going.
Not to say anything about Montana, beautiful area, but maybe just a little bit less demand.
yeah.
I'm from Kansas. How about we say middle of Kansas?
Okay, fair.
And I can say I love Kansas, but
Let's wrap it up here. A couple things that jump out to me from the conversation. As an investor, behave as if markets are efficient. All the current information out there, it's reflected in prices very, very quickly, and it's forward-looking, which goes back to what you said, Jake, which I think can bring a lot of liberation to your attitudes and your emotions around investing. I think it really just can reduce a lot of the stress that you may have when you just appreciate the fact that I'm getting a very fair price on the security. And then the other thing, too, is just you kind of live by those principles in your day-to-day life. This idea of making trade-offs and making the best decisions I can with the current information out there. That's kind of how I think about markets as well. Anything else?
No, that's well said. I mean, I think also just getting to this idea of don't take models too seriously. When people are trying to find things, edge cases that might be wrong with a model, it's the same thing as, okay, the Earth is not literally a sphere. We always think of it as a sphere. That's fine if that simplification suits your purposes, like building a globe for third grade art class. If you're trying to get a satellite into orbit, then maybe you do care about the limitations of that model of abstraction. But in the case of market efficiency, I think we already settled out why the abstraction from reality actually suits investors' purposes perfectly well.
The only thing I'll leave them with is we come back to it repeatedly, which is, so what are you going to do about it, right? We can sit around and have these discussions. You can have opinions on that. But at the end of the day, what are you going to do about it as an investor?
All right, guys, thanks for a great conversation here today. And thanks to all of you for joining The Informed Investor. We appreciate your time. And also be sure to check out David Booth's newsletter, Stay Calm Investing, and you'll get some great insights as well about markets. Thanks, everybody, and have a fantastic rest of the day.